Long-term investing sounds easy in theory. You buy great companies, hold them for years, and let compounding do the work. But in real life, it feels uncomfortable, boring, stressful, and sometimes even painful. That discomfort is exactly why most people don't build real wealth investing, even though they know what they're supposed to do. Long-term investing isn't hard because it's complicated. It's hard because of how it makes you feel. Our brains are wired for short-term survival, not long-term wealth. They evolved to react quickly to danger, and in investing, red numbers feel like threats even when nothing has fundamentally changed. A 5% pullback feels urgent. A scary headline feels like a warning. A market crash feels like something you must act on immediately. Long-term investing asks you to do the opposite. Stay calm, do nothing, and wait. And doing nothing feels wrong to a brain designed for action. Volatility also feels like failure. When a stock drops, it feels personal, even if the business itself is doing just fine. We're conditioned to believe progress should be smooth and consistent, but markets don't work that way. Long-term returns are built through years of uncertainty, drawdowns, and boredom, not constant wins. Most people misinterpret volatility as a bad decision instead of recognizing it as the cost of staying invested. There's also a painful paradox in the market. It rewards patience financially, but it punishes patience emotionally. While you're holding, someone else is bragging about quick trades, headlines are screaming recession or collapse, and your portfolio looks like it's going nowhere. The payoff comes later, quietly and slowly, often after most people have already given up. That delay makes long-term investing feel like it isn't working even when it is. Another issue is that boring doesn't feel productive. Buying feels productive, selling feels decisive, holding feels lazy, but boring is powerful in investing. The biggest gains don't come from constant action, they come from letting time do the work. The problem is patience doesn't give dopamine hits, so your brain starts looking for something else to do, usually something that hurts your long-term returns. That's why most investors quit right before it works. They don't fail because they chose terrible investments. They fail because they quit during drawdowns, chase what already ran, or sell when emotions peak. Long-term investing often feels the hardest right before it starts paying off because doubt is high and rewards are still invisible. That discomfort isn't a sign you're wrong, it's often a sign you're early. The key mindset shift is understanding that discomfort is a feature, not a flaw. If long-term investing felt comfortable, everyone would do it. Discomfort is the barrier, and barriers are what create opportunity. The market doesn't pay you for being smart. It pays you for being patient when it's emotionally difficult. Long-term investing goes against human nature. The goal isn't to eliminate discomfort. It's to expect it and stop reacting to it. The investors who win over the long run aren't the ones who feel the least fear. They're the ones who act on it the least.